Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Hello, it's the market call. I'm Dan Nathan. Guy usually kicks this thing off because he's got these dulcet tones as he I see his mouth moving, but we can't hear him.
No, my mouth isn't moving.
Right.
I'm a ventriloquist.
Liz Thomas is here.
Get my computer out of the way.
Yeah, let's get it out of there. Guy, you're gonna really enjoy her fit, as the kids say here.
I see it.
I feel like I've been missing out on some of your banter about Wisco Sports.
Yeah.
You guys have been going back and forth. Is there anything you want to get in there?
I do. I would like to. Thank you, by the way. It's 11 a.m. on the East Coast. Amanda, by the way, is doing great. So Monday, Elizabeth and I, as we typically do, we sat down, we had a conversation, and we started it with just what's going on in the state of Wisconsin and their professional sports franchises. Obviously, the Packers playing well. The Brewers in the National League Championship Series with home field advantage against the Dodgers. And as we were talking, she made a point of saying that Griffin Thomas, her son, was been wearing this onesie, and every time he wore his Brewers onesie, the Brewers emerged victorious. I'm like, that's amazing. You know, he's going to obviously wear it tonight. And she said, we left it out east. And I said, well, then get your ass out of here, get in a car and go pick it up, because this ain't going to work. And sure enough, Swizzle is right. They go down 2-zip at home because Griffin Thomas didn't have his onesie on, Dan.
Well, he's going to have it on tonight.
Yeah, he is.
608. He's going to have it on tonight. It is clean. It is laid out on his dresser. It is waiting for him.
You know what's waiting for us, Guy, is a sea of green on my FactSet machine. You see what I did there?
Right to the market. You don't have no interest in Milwaukee sports. I hear you.
By the way, can I just,
Sure.
for anybody out there who doesn't know about this logo, you don't realize by just looking at it that there are only 3 fingers and a thumb. It's because the logo is actually an M and a B for the Milwaukee Brewers. It's not
brilliant.
Not just a baseball.
So, by the way, if you look closely at Liz's fingers, you might see some orange chalky stuff, because before we got started, she just had some Cheetos, which looked amazing. She tortured me. So a sea of green, Guy. Why, or do we have a sea of green? Because
the market's open, Dan, and that's been obviously been going on for quite some time. And you know, it doesn't really seem like anything matters at this point. Even Treasury Secretary Bessent, with some pretty aggressive language in terms of the back and forth with the Chinese, didn't seem to stir the markets, because, you know, I hate to use the word complacency, but I think it's this learned behavior that, you know what, all this rhetoric is fine. We're not going to play your reindeer games again. We got fooled in April. Maybe to a certain extent, we got fooled on Friday of last week, and we're just not going to go down that rabbit hole.
Yeah, I mean, Liz, let's just talk about this for a second, because, you know, there was all this discussion about what, and we probably talked about it in the lead up to the shutdown. We got these dates, you know what I mean? And we got to kind of hit them, and things can go haywire, you know, in you know, the markets, and then maybe it flows through to the economy. And, you know, there's a bunch of stuff from a legislative standpoint that needs to get, you know, all of this stuff. So it comes and goes. Nobody cares, right? And then we have, you know, the trade commentary going back and forth between China and the U.S. We had one day that folks cared, and now they don't care anymore, right? And so Guy's point about Bessent, and they're getting a bit aggressive here. We don't care about the stock market, all that sort of stuff. So at what point, you know, is this going to, you know, seep into, because Guy said this last week, actually, after that Friday, you and I did a pod after the market collapsed. You're like, this just sets up for a huge bounce once we get the taco trade. You know what I mean? So if nothing matters, to Guy's point, like, is there just way too much complacency in the market?
I mean, there's definitely complacency. I think it's just that still investors are not looking at the economic data, first of all, because there isn't any, but they're not looking at the economic data as what's driving their investment decisions. What's driving their investment decisions is still AI, the CapEx cycle, all of this stuff, right? It's a broken record. And I'm not saying that that's necessarily wrong, but some of this other news has just kind of been interpreted as noisy, and it's not something that's going to change people's decisions about what they're buying in the stock market today. The China thing, I think this is going to get really interesting. And I agree, you know, Friday, and Guy, we talked about this on the pod on Monday. I was surprised by Friday's pullback because it was like, haven't we learned by now that this is just sort of
All right,
like hocus pocus?
Was it just a reason to sell stocks? And the hardest hit stuff was the stuff that has led us, you know what I mean, over the last, I don't know, 2 years at this point. But I was doing some chart work earlier, in the week. I mean, when you see the amount of stocks that are up 80, 100% off the April lows, that sort of thing, I've never seen anything like this, especially with companies with real market cap. Look at this Celestica, okay? This is a company that is a contract manufacturer, so they make a lot of the equipment that goes into the data centers. Look at this thing. Off the April lows. This is a $32 billion market cap company that literally just gained $16 billion in market cap, and so like there's just so much of this stuff going on, and people want to compare it to other periods. This is getting to a point. I've never seen a frenzy of announcements in and around a secular shift like we've seen, and obviously, to the extent, Liz, that we've seen,
Yeah. First, totally off topic. Bill, can you come over and move this microphone? That's right in the middle of my.
Oh, I like this. This is behind like the fifth wall or something.
Thank you.
Look at that. I just nailed that.
I can't see any of the charts. Okay. So there's extended activity in the market. Taking this just to like a conceptual level, if there's not a big exogenous shock that causes a pullback or a recession or a crash, it has always been caused by excessive risk taking, excessive speculation in the stock market. Are we in a period of excessive risk taking and speculation? I would say yes. Are we as excessive as we've ever been before? No, not yet. Will we get there? Probably. I think everybody has agreed so far that this is some sort of a bubble, whether you like the B word or not. This is some sort of a bubble. It will eventually end and probably not be cute when it does end. But does that mean that AI is imaginary and it doesn't become a world-changing force? No, I think it still does, but some of this speculation has to unwind. So events like Friday are opportunities for that excessive speculation to unwind. And that is what happened. And it didn't happen in a generally orderly fashion, but it happened in the way that we would expect.
You mean Friday?
Right.
Yeah.
But it happened in the way that we would expect. The stuff that had run up the most, the unprofitable stuff, the low quality got hit the hardest. And that is the way that it should happen, right? If it's just a speculative unwind.
And leverage, by the way. And that's if you want to throw the Bitcoin at the end of the day, and that's one of the things that could really be a bugaboo if we do have a sustained sell.
But that's always an element of excessive risk taking.
Yeah.
There's always leverage that starts to build up in the system because that's how people take the excessive risk.
And we're not talking about margin debt, like retail margin debt. We're talking about like some of these treasury securities and that sort of thing. But Guy, on the bull market thing, your first job, a lot of people think that you started at Drexel Burnham, but when you were an intern for the legendary investor, Sir John Templeton.
I used to call him JT, by the way.
JT, he's got this like famous saying, and if you Google this guy, he's got a lot of famous sayings about the market, but bull markets are born on pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. And I'm thinking to myself, Guy, I think we've seen all of these in the last year or so. And so do these cycles just get ramped up because people are like, are we in 97 or 98 or 99? Right. Maybe it's just like maybe a 2-year thing or a 3-year thing. I don't know.
What's amazing is sometimes, there are periods of time where we get all those things in the course of a week, it seems like. And that's just, I think, the fickle nature of the market right now. But it's true. But in terms of the longer cycle stuff, I think Liz is right to point out that the optimism out there and the speculative juices are absolutely flowing, and we're seeing it in a number of different things. Now, where we're not necessarily seeing it, though, are some of the concerns I have. We'll go to Liz's slides in a second, but Bitcoin not trading particularly well in an environment where if you had told me all the things that are going to transpire, especially if you told me that the Fed's going to start to walk back the balance sheet, the reduction of the balance sheet, I would have thought that would have been extraordinarily bullish for Bitcoin, but there's clearly something going on there. And then obviously the gold market, which Liz has a lot of slides that her and Mario put together. So those two things in and of themselves, to me, are flashing some warning signs. Again, I'll say this quickly, Dan. The technical damage that I think we did last week in the form of Friday's action, not a classic engulfing pattern, but pretty damn close, I still think is intact and something we're going to be talking about in the weeks to come.
Yeah, the Bitcoin unwind, first of all, that was one of the most dramatic drawdowns on Friday in asset classes. That part, the fact that it hasn't recovered much like the rest of the stock market has recovered, is a bit of a head scratcher. Because even if you look at it and say, okay, it turned into a very risk-off environment, classic risk-off environment, you'd expect that Bitcoin would sell off, especially with the non-profitable companies that had ridden everything up. But it didn't bounce. And that I'm not quite sure why. And you have to ask yourself, so then where did those holders go? Did they buy gold instead? I find that hard to believe, that they just transitioned out of Bitcoin and into gold because of one day. So I'm not sure what is happening there. And I think it's going to take a little longer to figure that out. The gold trade, which of course we can get into, and I want to get into it in a number of different ways, but the gold trade, I think, is being driven by entirely different things than what we're used to and what we've been used to over history because of the environment we're in. I'm not saying this time is different, gold will be different for the rest of our lives, but I think in this environment, because of what's going on with currency and the fear of debasement and all of these inflationary concerns around the globe and central banks' independence or lack thereof, that's part of what gold is looking at right now. And I think if you just take the stock market too of what happened on Friday, people saw it as an opportunity, right, to reposition, which I think many have done and were hoping to do before the end of the year. And maybe they took that opportunity Monday, Tuesday, Wednesday of this week. And now we're sort of back in this place. The technicians will tell you that we're in a period of this market, the stock market, where the levels have been really, really important. And I don't know how much Carter stuff we have today or what you guys have done this week with him, but the levels of support are really important in a number of different stocks and a number of different asset classes. And the relationships between things like consumer discretionary versus staples are what need to hold up here to further reinforce that this market is still healthy, because they're getting to that point where things are feeling a little less healthy, right? The number of stocks in the S&P at 20-day lows is increasing, right? There are just these sort of transition points in the technicals that are making people get a little more on edge.
Yeah, Guy Adami. Let's, because you've been talking about this, and a lot of folks were curious about this, and we've said it on this program before. You said probably 100 times, gold is going to be a thing, and your point about a thing. Just describe that, because I think you really thought that, yeah, it could continue to go up and the market could continue to go up, and really, who cares about what the dollar is doing, that sort of thing. But the thing is a really important thing. Just describe that a little bit, because that's the thing. It's the disconnect between the rest of every other market.
Total disconnect. And Elizabeth's been talking about this for a while as well, and she has slides and we'll go to them. But when I started, and this is now going back a few years, when I started reading about the amount of gold that central banks were buying, and again, 4 years ago, it was a record amount led by the Chinese, but not entirely the Chinese, some 1,100 tons or so of gold, something historically they've really never done. It sort of perked my ears up. And then when it happened again the following years, I'm like, okay, something's going on. And then I was starting to try to connect the dots and say, well, why are they doing this? And the phrase that I've used, and I'm not suggesting I'm right, but I think they're hedging their own ineptitude, or maybe better way of saying it, I think they're hedging against what they feel is sort of the inevitable. And again, with this concern about fiat currencies and just the excess that's been in the system for a while, I think a lot of these central bankers realize, well, there's going to be some safety in being in gold. And that didn't seem to be working for a period of time. Gold was sort of flatlining, but still hanging around. And then obviously over the last couple of years, you've seen this sort of, for gold, this is for gold, a bit of a parabolic move. Again, historically, it does not double in the course of a couple of years, but yet here we are. And I still think gold is the thing. And now more and more people are coming to the realization that, wait a second, what is in fact going on here? Like, why isn't there a pullback? And people will sort of point to the retail demand. That is a very, very small percentage of what's going on here. A couple of schlemiels going to Costco on the weekend to buy a couple gold bars is not moving the needle. It's not obviously hurting, but it's not doing what gold has been doing. And that's, again, on the back of central bank buying, now a little bit maybe on the back of speculative buying, which I guess is fine. But again, the outperformance of gold vis-a-vis just about every other thing you can look at should be concerning a lot of people. I know it's concerning me. Now, with that said, there's been no cause for concern in the equity market. I just think it's a matter of time.
All right. So that was the second shout out to Wisco, specifically Milwaukee. I know what you did there, guy. Shamil.
Schlemazel.
Schmazel.
Mm.
What's the incorporated? What is
Huff
that?
and Pfeffer, I believe, is correct.
Oh, that was the
Elizabeth
beer.
knows
Do you
it.
know that? You know this.
I've heard of it, but
It's
no.
Laverne and Shirley, which was a spin out of Happy Days,
Yes.
which
Oh,
also
come on.
plays in one. Come on,
Yeah.
stay with us.
Elizabeth knows this.
All right, so we just referenced Liz's charts, and they
Yep.
come from a note. Each week, Liz and Mario write a really interesting piece. It's often, equity market related, but this is a bit more macro. And so if you want this report in your email box, you can go to SoFi.com/on-the-money. Sign up for it there. You'll have it in your inbox, but we get a preview of it because Liz is right here on Thursdays. Liz, talk to us.
Yeah. By the way, I was distracted because Mario had just sent me an instant message and said, I'm watching the show. Gold is almost at 4,300. Every day it's adding.
Hello,
about
Mario.
Hey,
Wow.
Mario.
So Mario wrote this note this week, and the title of it is "Ooh, Shiny." This is all about gold. We did he did a deep dive on it. So I don't want to cover necessarily all of the charts, but some of the big takeaways. I mean, this is just showing you returns and volatility, and we just wanted to show this to just basically exhibit the surprise factor, right? Stocks, the numbers are normal. Average returns on an annualized basis, about 11%, volatility about 15.5%. Those are totally normal numbers. Bonds, roughly normal, right? Returns 6-ish, volatility 5-ish. Maybe volatility is a little higher than normal, but gold, annualized returns 8.1%, volatility is over 19%. Now, there are different ways to measure volatility. Oftentimes we use volatility on the negative side. This is showing us we've got volatility on the positive side, right? Gold is blowing through expectations by standard deviations on almost a weekly basis. And the chart itself just shows you that. So this is the experience we're having in the market right now. And I think that's what has made it such a head scratcher. I mentioned technicians before. I don't think you can find a technician out there who's going to tell you that the chart doesn't look a little extended on gold. It's above all of its moving averages. It's way overbought, right, by all of their metrics.
50% above its 200-day moving average. Guy, do you think you've ever seen it? 50%
gold
of its above its 200-day moving average?
Because it doesn't move that way.
Yeah.
Right. So, and this is emblematic of how that's happening, right? This volatility bar on the right side is mostly positive volatility. Next slide. This one will help sort of answer the question. So we're pointing out here this vertical line: Russia invades Ukraine, sanctions on Russia, the dollar was weaponized. Okay. So we all know that central banks have been buying gold. And by the way, when central banks buy gold, they do it in the over-the-counter market. They're buying actual gold. They're not buying ETFs. They're not buying like some figurative whatever. So they're buying gold. The price of gold is reacting to that. So the weaponization of the dollar happens. Now, this is me speculating. I don't have all the central bankers around the globe on the phone. They didn't tell me this is why. But if they were honest and said, yes, that's why we did it, I imagine it's because they saw the dollar get weaponized. They knew that they had a bunch of their reserves in dollars. They don't want to be the victim of that same thing, and said, you know what, we need to protect ourselves from that possibility, even though we don't intend to break out in war with anyone. But let's reduce our dollar reserves and increase our gold reserves. And gold can be denominated in a number of different currencies. So demand from central banks increased because of that. And actually, if we can skip ahead to the next chart, this is how much the demand from central banks actually increased. So there's an average of pre-sanction, so pre-Russia, right? 126 metric tons. Post-sanctions, that went up to 273 metric tons by central banks. This probably stays this way until that dynamic changes. Maybe it stays this way forever, and central banks are just going to have that sort of demand. Next chart. I'll move through this one pretty quickly. Guy, you mentioned that the retail trade is a very small proportion of the overall gold trade, but this is what's happening right now. And this is why I think it's hard to listen to technicians and say, yes, it's extended, it needs a pullback, it's going to happen. There's still number one, there's still a lot of sticky demand from central banks, right? They're not going to suddenly sell all their gold because something's changed. So that demand is going to stay there. And then you've got retail, which is this blue line, that's ETF holdings, still chasing the rise in price. So you've got, even if it's a small amount, you've got demand from retail and stuck demand from central banks. So yesterday, Mario and I were having this conversation, and I was like, what what tells people to sell gold? Like, why would you even sell gold right now? It'd be hard, I think, to convince even retail to sell a lot of gold. And even if they did, does that really even move the price? So I understand that from a technical standpoint, the chart looks like it doesn't make any sense. And it's hard to say this is where you put new money to work. But it's also possible that this just keeps running because of the environment. And I don't know if it was Jamie Dimon earlier this week that said, yeah, gold could be at 5,000, maybe even 10,000 at some point. It could. Right. Why couldn't it? Right?
There's nothing. There's nothing. So the question Liz brings up, and she has a gold and copper chart that we should look at as well, because that I think is interesting. But what can derail this is basically what she's saying. And I don't think it's central banks selling it, because I don't think that's what the game is here. So what could possibly derail this thing is in a risk-off scenario, if the equity market were to sell off in a meaningful way, gold gets caught up in that. If people are finding themselves with margin calls, things that have to be forced liquidation, gold loses that environment. It doesn't lose its entirety. It doesn't lose in the long term, because I do think there'll be a snapback that's going to be fierce. But over the course of a week or so, in an extended sell-off in the equity market, you could absolutely see gold, give back the excess that we've seen in terms of the RSI and some of these overbought conditions, and sort of find its footing at previous resistance. And I think there's a chance that could happen. So that, to me, if there is a case to be concerned, that to me is the case, Dan.
Yeah. And that's, I like the fact that we're putting together the ratio versus copper too, because this is the one that probably has much more to affect around the economy than it does, from a risk asset, the way we think about gold.
Yeah. So traditionally, you look at the copper gold ratio, much like you look at other cyclical ratios. I talk about consumer discretionary versus staples a lot, or things like semiconductors versus software. This is a very similar idea. When copper is rising, because right now copper is in a sort of a different place too because of AI, but historically, copper is a very cyclical metal because it was used in home building, and we know that home builders are very cyclical. It was used in manufacturing a lot. So if copper prices were rising because demand was increasing, it typically meant that activity in the economy, manufacturing activity, construction activity was also rising, which was a cyclical and bullish signal. In those environments, gold would not be rising because people aren't scared of anything. They don't need to buy their store of value. Right now, as you can see, this ratio is moving down because the denominator, gold, has been rising so much. And it's not that copper has done terrible, but it certainly hasn't gone up as much as gold. So this signal in and of itself is not sending a cyclicality signal. There are still a lot of cyclicality signals out there, but this one is telling us that it's not great. Now, it could be that we're in a period where home building has slowed down. The number of projects and backlog have fallen, and that activity just isn't there anymore because the housing market is all but frozen. And then we've got this anomaly with gold moving so much. So this ratio is something that it used to be pretty straightforward. I don't think it's as straightforward. I mean, how do you interpret that and say, well, this means that we're headed into a recession because copper's not going up and gold is? I don't think that's what it means, but the relationship has changed.
Yeah. And I think this is what I take away from this whole segment here, is that a lot of correlations that we've become really accustomed to over the last, decade, 2 decades or whatever, they're breaking down. Right. You know what I mean? Which to me is another thing that you probably want to keep a close eye on, because if everything starts moving in the same direction, it just speaks to just this level of speculation. And, you speak with gold, normally you don't see central banks chasing a risk asset, right? You know what I mean? Like that sort of thing. So again, all very interesting. Thank you, Mario. Where, Guy, you can find this?
It's like SoFi.com//- on the money.
So SoFi.com/on-the-money.
Or you can just go to the website.
Oh yeah, that too. When's your podcast coming out?
One dropped yesterday, the first one of this new season.
Okay, who do we got?
With Mr. Dan Ives.
Amazing.
Yeah.
Wow. We love Dan Ives of Wedbush. All right, let's hit this because we spoke to leverage for a second. And I don't know if you guys were paying attention, but yesterday at 3:12, okay, Ethereum had this move. You see this, what was going on here? So Paxos, which is a crypto infrastructure company that mints and manages PayPal's Stablecoin. Now, we've been talking about this. Why does every financial company need a stablecoin? I'm not sure. It's something that is supposed to. I mean, I literally don't know. Okay, so going back to the OG stablecoin, this was Tether. I think it was like 5 years ago. It broke the buck. What is this? So a stablecoin is just this cryptocurrency. It's meant to be backed by a dollar, right? A fiat currency, by the way, or a treasury equal to that of a dollar. When Tether broke the buck, and we've seen this before. I think you got to go back to the financial crisis where we've seen, money markets break. It sends ripples through the financial markets because it's meant to be something that's sacrosanct. Guy, is that a proper word there?
Wow, I like what you did there.
And so yesterday there was a fat finger. And Ethereum, they basically minted like $300 million of this thing. It just kind of sent shockwaves through, a lot of these other, stable coins or crypto assets or whatever. And let's just pull up a 1 year. I mean, it didn't matter. I mean, we've gotten a lot of it back, but the trust in these things is so important. And that we talk about leverage, you talk about, is this a, solution in search of a problem? It's also interesting to note, if all of this stuff is supposed to be DeFi'd, why is it trading on these sorts of rails? How is it that Paxos can just turn off, you know what I mean? Like a risk asset like this. So I just think that's really important. And then if we go to the Bitcoin, this thing is hanging on for dear life at this 110,000. And again, this is one of those correlations. You would think this is moving in the same direction as gold, and it is not. So you know what? Smarter people than me are going to figure out why this is happening, and we might see something. Maybe this is some sort of canary in a coal mine.
I 100%. And you've been bringing this up for a while. I mean, I think you brought it up with a number of different people on a number of different podcasts and market call shows, and I think it's fair to take a look at. The leverage there is leverage in the system, and I think it's going to find its way at some point. I think it's going to find its way to the equity market. Doug Cass wrote about all these levered ETFs. I think more and more people are focused on it. Again, go back to Jamie Dimon, some of the comments that he made. He didn't exactly sort of call these things out, but I think there's a level of concern as well. So contrary to what people believe, I mean, the leverage in the system is absolutely there. You're just not seeing it because things seemingly go up every day.
Yeah, and the other thing is we didn't even mention these treasury stocks, you know what I mean? Like, so the strategy, and there's like 100 of them now that are selling everything that's not bolted down at their company, right? And they're raising cash to buy, whether it is Bitcoin or whether it is Solana or Ethereum. And there's leverage there. These things are trading at multiples to their NAV, you know what I mean, a premium to them, that sort of thing. So it's been my belief that we're going to have whatever happens in the market when we have some sort of AI, kind of digestion or blip, we're also going to have an unwind in some of these things, and we might see stable coins act in funky sort of ways. We've been there before. So for whatever.
Yeah, well, and I think some of it, and I don't want to say it's fake, it's not fake, but I think some of it is creating the illusion of safety, that if we pull away from the stuff that is traditionally volatile, or stocks that are going to pull back, things that are traditionally happening in a risk-off market, there's this illusion of safety in these alternative assets. And when there is an actual crash, if there is an actual crash, there's nowhere to hide. That's just how it works, right? You can't really hide aside from taping your money to the back of your toilet. Like, really.
Whoa, is that a thing?
That's just how it is. So,
guys, what else could you tape to a back of a toilet?
Tape a gun. I got to leave in a second because I got to get in the car. Of course, in the great movie The Godfather, that Elizabeth probably has not seen yet in its entirety, but should. Clemenza has one of his people tape a pistol to the back of one of those toilets. It's one with the chain.
Who gets whacked?
Whole thing. Now, well, think about it. Virgil Salazzo, and then of course McCluskey, the Irish guy, the cop who's no good.
McCluskey was a real a-hole.
Well, listen.
I mean,
yes,
he broke Michael's face. I mean,
yes, he did. And he was, he got his right.
He did.
But if you watch the movie closely, Elizabeth, this is directed at you. You will notice that when Al Pacino walks into the men's room, he starts fumbling around trying to locate the gun, because in the script, the gun was supposed to be in a certain place. And when he put his hand up there, it wasn't there, because the genius of Francis Ford Coppola said, don't put the gun where he thinks it's going to be, put it on the other side, and we will capture his sort of frenzied concern, thinking the gun might not be there. Brilliant directing from one, of course, my favorites, Francis Ford Coppola.
And
by the way, go ahead.
Well, I was just going to say that instance, that whole situation sent Michael on a little John. I mean, he got to meet Apollonia.
Can I tell you something? He knew he had to go away for a period of time. As a matter of fact, if you remember, he says to Sonny, you know, how long you have to be gone for a while? Don't worry, I'll handle it with the girl. The girl being, of course, Diane Keaton, who we tragically lost this week. I mean, I can do this for hours. Unfortunately, I can't because I got to get in the car.
Another podcast, Guy Adami. We have a very special risk reversal podcast.
Yes, you talk about it while I dip.
We have Vincent Daniel. We have, where did he go? Porter Collins. We have Danny Moses. You guys know who those people are. They're the Big Short gang. Guy and I, we're never had a jumbo pod like this. All five of us. Yeah. So that's going to drop tomorrow. Maybe we have, but maybe one of them was not here. We're going to have 5 people around this table.
Wow.
So check that out.
Tight table.
So Liz, we had the money center banks with the investment banks report this week.
Yep.
I don't think there was a single thing you could look at them and say, well, Jamie Dimon, rained a little bit on the parade, talking about, expanded reserves for losses and that sort of thing. He's always a bit cautious on the consumer. But the thing, and we don't have to go over that today, look at what's going on in the regional banks.
Yeah.
So talk to me what
basically.
Well, I mean, the KRE is down 3%.
Yeah,
I mean, so on a day where the BKX continues to hold in all week long, there was nothing to really shake a stick at with those earnings. Is this troubling to you at all?
Yeah, it is. Well, and Guy and I talked about this a little bit on Monday. Basically, the net interest margin argument of a steepening yield curve is supposed to be a tailwind for everything financial, right? It hasn't really come to fruition. It hasn't offset some of the other concerns, and regional banks are much more sensitive to that. So if NIM is actually increasing, regional banks should actually be some of the biggest beneficiaries.
Right.
And that's not happening. So for whatever reason, a steepening yield curve is not providing a tailwind to regional banks. This is concerning because there are obviously different revenue streams for these banks, but not nearly as diversified of revenue streams as what you see in the big banks. Big banks have capital markets activity, investment banking. They've got consumer stuff.
Everything was
institutional stuff. Everything was good. They've got their own trading activity.
Except at Jeffries.
Well, that was
a different scenario.
Yeah, right. Yeah. That was a little bit more isolated. But the regional banks, the reason this is concerning is because I would consider these probably the most cyclical of cyclicals in the financial sector. Regional banks are going to spend a lot more of their time and get more of their revenue from the consumer side of the equation. If consumers are struggling, so if consumers are not taking out as many loans, or if credit quality has fallen, right? On the consumer side.
All right, but on the institutional side, it seems like we're starting to see some credit quality deteriorate a little bit. And that's
Spreads
what this
are
first
not
brand
showing
situation.
That yet. Exactly.
They're tight as can be.
Spreads are as tight as can be, which you could look at that as they're ripe for a blowout, or it's just not showing up as stress in the system right now. So there's no signal, right? There's no there. But regional banks have a client base that is much more consumer focused. So maybe credit quality is falling and they haven't changed their underwriting standards. So they're just not lending out money as much, which means they're not making as much revenue. I don't know if this is really the case, but that's why it becomes concerning, because this is where you might see stress in the consumer show up. This is where you might see an indicator that cyclicality is really under pressure and we have a problem, especially on the consumer side of the equation, and that lending activity from banks is what happens in a healthy economy. It sort of sounds counterintuitive at times that you increase the amount of lending in the system and that's what increases money velocity, every money supply, all of it. It is actually good when the economy is healthy. If they're not lending money out, there's a problem. There's a reason they're not doing it. Either there's less demand or they don't feel comfortable doing it. So there is something to pay attention to here. I don't know what the major cause is yet, but there is definitely something to pay attention to.
All right. So last night on Fast Money, we had the CEO of KBW. This is a Stifel company. I think they were bought a few years ago. KBW is pretty much, they don't have a trading operation or a meaningful one. If they do, it's really about banking for the financial sector. And so the CEO, Tom Mashad, who's been on, I think I pronounced that correctly, he's been on our show a bunch, really smart guy and really obviously great insights to what's going on, not just because he's the CEO of that bank, but they also bank for a lot of other banks. And so he was talking about just this pro-growth environment, this pro-growth agenda, this deregulation environment.
Oh, yes.
That
I forgot another point.
Should be good for regionals, right? Yeah. And that's been the story. And if Amanda can pull KRE up, I mean, it doesn't act well. I mean, just look at it, right? And so, I said to him, if we are in an environment where everyone's geeked up about dereg, everyone's getting the benefit of this tax cut, right? If we're starting to feel, animal spirits, right? You would think that this sector should benefit. So if we have, easy financial conditions right now, and the Fed is starting to a rate cutting cycle, I just said to him, man, we've been through this before. Give bank CEOs or managements enough rope to hang themselves with, and they'll do it. You know what I mean? So the deregulation the regulation is not a bad thing, if you go back and look at the last 20 years. So just thoughts, because, Jamie Dimon said, he was talking about this First Brands, bankruptcy. He said there's usually more than one cockroach.
Of course. Right. And that's just maybe the first one we heard of. Now, is it going to be this sudden, avalanche of stuff? Probably not. I feel like we would know a little bit more about it by now. A point I forgot to make before, this would be kind of a bull case, or it would be a reason that you look at this pullback and say, well, maybe this is a buying opportunity. As we move into 2026, there are a number of Fed governor seats that are going to turn over, and there can be changes made to increase that number. We obviously know the ongoing Lisa Cook stuff, which actually might not get finalized.
It's amazing that just died.
Well, it's just not over yet. It basically got postponed.
I guess the Supreme Court kind of pushed it out.
It got postponed, and now it's like the Fed sort of has special treatment because it got postponed.
Right.
I think trying to protect the independence, or at least the illusion of. Anyway, so the Lisa Cook thing might not even happen until after the seats change. Going into 2026. If the administration gets at least some of what they want with that board of governors and puts some more administration friendly people in those seats, and then we have probably a clearer picture of who's in the running for Fed chair, the board of governors votes on financial regulation. If we end up with a board of governors that will also replace the regional Fed chairs with administration friendly people, then you've got a dovish Fed, right? An extra dovish Fed voting on dot plots, things like that. And you've got a board of governors that is friendly to the administration and has the ability to vote on financial regulation. That could be a bullish signal for regional banks going into 2026 if nothing else breaks down. There's also a decent amount of consumer stimulus coming. Tax refunds, things that could change. Now, some of them are a little bit harder to execute, but if it does happen, there's a decent amount of cash going into, let's call it middle class consumer pockets. Also stimulative in 2026. If that activity picks up, that probably benefits the regional banks too, as I talked about before, because they're more exposed to the consumer. So
to spend
that would be the bull case.
Depending on a labor market that seems to be weakening.
Yes, I mean there's a lot of things that
and there's a lot of things.
Out.
Government is cutting a lot of jobs, right? AI maybe is starting to displace a lot of jobs, right? So those are things. I mean, there's a push and pull. I'll take that whole argument about dereg and then easy money or financial conditions. Here's the problem that I see, and I'm not trying to be so negative. I think a lot of our listeners, a lot of our viewers know that I am a believer in what's going on from a technology standpoint. I believe that there's no shortage of industries that are going to become a lot more productive because of AI. It doesn't seem to be happening at the moment. You just have hundreds of billions of dollars being spent, hundreds of billions of dollars in hardware or data centers that are not being properly depreciated right now, right? Especially if you see the cycles of a lot of these chips, if you listen to Jensen Huang from NVIDIA, right? And so to me, I look at the spend right here and I say to myself, if these companies continue to give 5 gigawatt sort of, contracts to Oracle, which literally could cost, you ready for this? $300 billion. Start calculating a gigawatt at $50 billion. Okay. Then you start thinking about this upfront spend. And then you say, what are the revenues that we're going to need to see to kind of justify this spend in the future? Right. So to me, if you start seeing increased lending, and we're starting to see it in what you call, the unregulated private banking sector, look at how poorly KKR which just did a deal, a $30 billion deal to finance a data center for Meta. Pull that up, KKR, for a second. You know, Blackstone and BlackRock and Apollo and Carla, they're all getting into this game.
Yeah.
And all of this debt is going to find itself into ETFs. They're going to find itself into 401ks, you know what I mean? That sort of thing, just because there's going to be a need for diversification, you know, all this sort of stuff. So to me, the financial conditions thing could be a disaster if we get a politicized Fed and they just cut the shit out of rates. We are going to see a bubble that is already forming just go ballistic, right? And I just think the more this goes on, the more different ways to finance this build, you know what I mean, without any real ROI in the near term, that sets up for a really difficult situation. Who knows where it comes from? You know, I mean, like, thoughts on that, Liz?
Yeah. So some people's definition of a bubble, and this has flown around the ether in the last couple of weeks, is something along the lines of, you know, it's a bubble when the spending or the investment far outpaces the possible revenue that whatever this is could ever generate. We're probably not there yet, but we're getting closer to a point like that, where the spending is so astronomical that no matter how inflated your expectations are of the revenue, the productivity gains, whatever it is, it just can't possibly be made up.
Can I make one point here for a second? So OpenAI, which is a private company that is valued at $500 billion. We've never seen that before. They have, in the last few months, done $1 trillion worth of deals with infrastructure providers. They took an investment from NVIDIA, and NVIDIA, you know, they invested OpenAI in AMD, one of NVIDIA's biggest competitors. They did a deal with Oracle, one of the distant cloud players behind Google Cloud, Azure for Microsoft, and AWS, and then throw Meta in there. Okay. So like all of this stuff is starting to work itself down, you know what I mean, the quality stack, if you will. And all of these companies, in Intel on the Foundry, right? All NVIDIA invested there. All of these companies have to execute. So Intel, which missed every major tech cycle of the last basically 20 years, AMD, which is a huge laggard to NVIDIA, Oracle, as I just mentioned. So I don't think anybody is placing any discount to the ability for some of these companies to execute. And I think that's like something to me that is just like mind-boggling.
Yeah, well, and I mean, just generally, you know, if you take 15 companies, even in the same industry, and track them over a 10-year period, chances are at least one or two of those 15 didn't execute, regardless of how favorable the environment was. So somebody's going to screw something up somewhere, right? That's just how business works. But and Mario and I were talking about this earlier this week, looking at all of the circular funding diagrams. There are so many out there, and it's like, okay, if we're building a house of cards, though, number one, how does it end, right? Which one of these little bubbles in this diagram do you have to remove that would actually make the whole thing fall down? I mean, most of the arrows lead some direction to or from NVIDIA. Now, many of them lead some direction to or from OpenAI. So we know who the bigger players are. But right now, I think it still lasts because they've all been so rewarded by the market for spending. So they just continue to announce the spending. The growth rate of spending comes down considerably in 2026, and that's going to be something for the market to digest. But that's also not a secret. We all know that the growth rate's going to come down. So at some point, it does turn into there. Perfect. So yeah, so the arrows,
is like,
right?
This will break your brain, man.
Right, and Broadcom's not, because this was built by Bloomberg before the Broadcom announcement. This came out, this particular diagram, I think, came out like last Friday or last Thursday. The Broadcom thing happened on Friday morning. Anyway, so you have to add even another bubble here. So you look at this and say, all right, which one of those do I need to take out that the whole Jenga building falls down, right? NVIDIA, probably. OpenAI, right? You just look for the one that has the most arrows. But what brings either of those down? It's that spending would have to pull back, I think, number one. Or number two, maybe there's something else in here. And I don't know enough about this side. Maybe you do. One of the things that people used Friday as an opportunity for was to freak out about private markets. And you started to see all this stuff about, you know, nobody is realizing that private equity funds are gating redemptions, right? And that's happening behind the scenes. And I'm sure that's true. Is that the thing that could bring this down?
We saw that in commercial real estate, I want to say like 4 years ago. And I'm sure we were making a lot of noise about it, and it didn't end up being anything. Okay. But like this dwarfs that. You know what I'm saying? Like dwarfs it.
But is there enough? And I honestly don't know the answer to this. Is there enough connection between what's happening in the private markets and some of those concerns that would affect those diagrams?
All right. So let me tell you. So, Anthrop, we're seeing all these companies minted at valuations that are far bigger than most of the stocks in the S&P 500. Okay. All of these companies are losing money. Like OpenAI is supposed to be $14 million in revenue this year, and they're losing like multiples of that. And they're committing all this capital, okay, to the whole ecosystem that we saw. You could draw the same thing with OpenAI now, like that you saw with NVIDIA. So you say to yourself, these companies are losing a lot of money. OpenAI is not going to make money probably for 10 years, okay? They really have to actually have these models get better. They have to have uptake from enterprise, right? It can't just be ad supported at this point because there's too much competition. Think about Google. They talk about digital ads as the best business model that has ever been created. Google did not have any competition for 25 years. They took out Amazon, or Yahoo, they took out Bing, they took out everything. Okay. So that was a winner take all. So now you have all of these companies competing for the attention, for that mind share, for those, to see their ads, that click through, to engage with them. So you have OpenAI, you have Gemini from Google. Okay. They have to absolutely cannibalize themselves to stay in the game. You have Meta, and it's not just Facebook, but it's Instagram, and it's going to be, Meta AI eventually with their Llama model. You have Azure from Microsoft. Okay. These are all engines, if you will, that are going to be competing with each other. And so to me, it's very different than the Google. And then if you think of the financialization that's going on for companies that are massively unprofitable, and I'm not talking about Microsoft, Google, Amazon, and Meta, but the core weaves have taken out shit tons of debt to provide this infrastructure. Oracle has done that, right? Nebius, this is another neo cloud. I'm sure there's a half a dozen other ones. These companies, some of them are going to have really poor margins. Maybe it's the storage guys like Micron or something like that. We already know that Supermicro has, just horrible margins. Dell is not, it's a 22% gross margin company, right? So they're not going to get a lot of leverage. Like, and at some point, if you're a second or third and you're trying to get market share, you're going to have to compete on price, which is going to weigh on margins, which might be unprofitable sort of business, which is what we saw with Oracle from that internal memo that was reported by the Information last week. So all I'm saying is that if these companies, these money-losing companies, are getting VC capital to the tune of, I think it was $2 trillion, where do VCs raise money? From pension funds, from sovereign wealth funds, right? So all that money is flowing into the system. And, now you have the private equity or, alternative lenders in the game. You have the big banks that are going to be financing a lot of this sort of stuff. So to me, I think that's an underreported, it's not a story, but it's a theme that underlies all of this expected amazing technological advancements, but they're all interrelated at this point. Does that make sense?
That makes perfect sense. And thank you for that explanation. And, maybe that is one of the things that is the biggest risk. And that's why on Friday, people used it as the opportunity to freak out about it. One of the last things I want to say, I know this is a long show. Thank you, everybody, for still being with us. But one of the last things I want to say is when the China announcements come out, right? DeepSeek, all the other things, and there will be more, I'm sure, China trying to get into this game and compete. Some of the bulls would come out and say, well, this isn't bad. Competition is good. It's just going to increase the usage, and it's going to increase the use cases. It's going to lower cost, whatever. That's good for the people that are using it, right? The customers of the AI companies. It's not good for the profit margin of the AI companies themselves. And that's, to your point, right? There's a lot more competition in this, which I think is probably good for consumers, probably good for, I don't know, healthcare companies that are going to start using AI, right? Because they can find a lower cost option. But that lower cost option means that it's a lower revenue line to the company that's providing the AI. So again, back to what's the definition of a bubble? If your definition of a bubble is that the spending can no longer possibly make up for, or the revenue can no longer possibly make up for all the spending. If you've got pressure on revenue because of competition, then that's part of how that diagram starts to fall apart.
Listen, in the year 2000, somebody slapped one too many banner ads on Yahoo. And that was it. I'm just saying, like, I can't put my finger on that, but like, if you just think about it, right? And so, all these companies were competing for this market share, but then underneath, you had all the fiber being laid. I mean, they laid enough fiber in the late 90s to have like a gazillion Yahoos or whatever the hell, you know what I'm saying? So again, who knows? I don't mean to sound so pessimistic. I am extremely nervous about all the interconnectivity and all the hopes and dreams and the euphoria around this technology. We've never seen the speed in which capital is being deployed for anything on this planet. You know what I mean? And then you have to throw China in there. So if China is innovating in a way away from our technology, because we have export bans and the like, and Huawei is able to have some sort of breakthroughs, which they will. Right. You know what I mean? We have a lead right now, but they will. And I'm on the other side of give them our technology so they can be dependent on us. I don't think the Chinese are going to allow that to happen, which is one of the reasons why they put import bans on NVIDIA chips, right? And so if you are able to train your models like the DeepSeek thing, even if it wasn't $30 million like they said, but even if it's 200 million, whatever it is. So there's risk here. Just want to say that. Liz Thomas, this was fun.
It was fun.
We had a great time. Thanks for
fun.
being here.
Yeah.
Check out the Risk Reversal podcast tomorrow. Check out The Important Part. Go follow it in your favorite podcast store. That's Liz Thomas's new podcast, or season 3. 4, excuse me. Go check it out. I'm really excited to hear.
Check out the Brewer game tonight too. 6:08 p.m. Eastern time. We need all of your spirit on the Brewers side of the equation. The Dodgers don't need anybody's help.
We're rooting for the Brew Crew.
They've got plenty of money.
The Yankee fans are definitely rooting for the Brew Crew because Game 5 of last year in the World Series, that was not pretty. Right. Thanks a lot, Liz. Appreciate it. Thanks, everyone.